Welcome back to the Deep Dive. Today, we're delivering what feels like a time machine, really. We're going to fast-track you right into the core market dynamics as of Monday, December 8th, 2025. We've gone through a dense financial brief, stripped out all the noise, and we're here to give you the key insights just ahead of a huge week for the Fed.
That's absolutely right. The main mission here is to synthesize the market's current mood. And if you had to describe it in one phrase, it would be an intense wait-and-see posture.
Wait and see.
Exactly. All attention is just laser-focused on the Federal Reserve's pivotal public communication window this week, especially the release of their revised dot plot that's acting like a gravitational center for, well, everything.
And when we boil down the summary from our sources, there's this fascinating core tension, isn't there? Two forces fighting for control. On one side, you have this relentless structural optimism around AI and core crypto assets. But on the other, you have the very real constraints of high interest rates and tight liquidity.
It's the classic fight, the big, beautiful growth story versus the grinding reality of expensive money. We're calling it the high-rate divided liquidity paradigm. It's the framework for this entire discussion.
Okay.
And it explains why risk assets, tech, are hitting record highs, while at the same time, institutional capital is pulling back, causing these sudden pockets of volatility.
Okay, let's unpack that operational reality first. What are the key indicators setting the stage for the Fed meeting? We have to start with the cost of money itself, right? Interest rates, the Treasury yield curve.
Absolutely. If we look at the core data from December 4th, we saw the U.S. Treasury 10-year yield sitting around 4.11%,
Okay.
while the shorter 2-year was at 3.52%. Now, we have to interpret this. The short end is still below the long end, which is a sign of some market disagreement, but the spread is pretty narrow.
So what's the implication there?
It implies that while the market thinks rate cuts might happen next year, it's structurally positioning for rates to stay relatively high, above the historical norms over the mid to long term.
So the market doesn't really buy the idea of a quick return to those ultra-low rates we got used to. What does that 4.11% on the 10-year actually mean for you, the listener, when you're thinking about your investments?
It means the high cost of debt is entrenched. It's just baked in. Any company looking to refinance or take on big expansion projects, they're facing a significant headwind. It's a constant gravitational pull against aggressive valuation expansion, especially in sectors that rely on future cash flows.
And if the cost of money is high, we have to check on the availability of money. How tight is liquidity? Is capital sloshing around, or is the tap running a bit dry?
Liquidity is definitely tight, but, and this is crucial, it's not frozen. We look at the Fed's RRP, the Reverse Repurchase Agreement daily balance.
Okay, remind us what that is.
It's basically where banks and money market funds can park cash overnight with the Fed very safely. And that balance has been low, fluctuating in the billions, which signals some short-term funding pressure.
But the rate on the RRP is also high, isn't it? Around 3.75%.
Exactly. That rate is key. That attractive reward means holding short-term cash is a very viable, low-risk alternative to chasing gains in riskier assets.
So it's competition.
It's direct competition for capital. It acts as a natural brake on speculative appetite. I mean, when short-term government debt pays that well, why take a huge swing on a volatile tech stock?
That makes so much sense. The high-rate environment is an active competitor to the stock market. Now let's shift to the Fed's dilemma itself. This is what's driving that wait-and-see mood. We've seen the latest core PCE data, the Personal Consumption Expenditures Index. Can you quickly define that for us and then explain how it complicates the Fed's decision?
Sure. Core PCE is the Fed's favorite inflation gauge. It strips out volatile food and energy, giving a clearer picture of underlying price pressure. The recent data has suggested inflation is cooling, and that introduced the expectation of early next year rate cuts. The market just loved that.
But our brief is very clear. It says those cuts are non-certain. Why the uncertainty?
Because of the other side of the mandate, the job market. While inflation is pointing toward relief, job data still shows remarkable resilience. Growth is strong.
And that could reignite inflation.
It potentially could. So you have this genuine growth versus inflation tug of war. The Fed has to somehow reconcile these conflicting signals this week. They have to choose. Do they prioritize fighting inflation, the hawkish view, or supporting growth, the dovish view?
So we have all this macro tension, high rates, tight liquidity, a Fed on a tightrope. But let's check the market's nerves with the VIX, the volatility index. Our sources show it in a pretty low range, around 15 to 16, specifically 15.78. If everything is so tense, why isn't the VIX spiking? Is the market being irrational?
That is a brilliant question, and it really captures the essence of this moment. The low VIX tells us investors aren't panicking, they're positioned, they're not running for the hills.
They're sitting on their hands.
Exactly. They're waiting for the Fed's communication. This low implied fear suggests stable positioning, probably defensive and liquid, not necessarily high conviction. Historically, volatility often spikes right after the Fed speaks, once the uncertainty is gone and the market has a new path to react to.
That structural positioning is a perfect segue. If cash is constrained, where's the capital actually flowing? Let's dive into the asset dynamics of tech, AI, and crypto.
Right, and this is where that structural optimism really takes over. Broadly speaking, U.S. stocks are still strong. The S&P 500 is flirting with its all-time record zone, which we saw around December 5th.
Oh, that's all tech.
It's overwhelmingly concentrated in the technology sector, driven by that AI theme. You see indices like VOO and QQQM maintaining these high positions because investors view the AI revolution as, well, a tidal wave that justifies the high cost of capital.
And we have data on the titans of this revolution. How are names like NVDA, Geo-ERG, and Meta defying this gravitational pull of expensive money?
Because they are the infrastructure. NVDA is the undisputed leader in AI chips and data centers. It was trading around, $182 to $183. Its valuation is held up by the belief that its market share and pricing power are basically bulletproof no matter what the Fed does short term.
Okay. And Meta and Google.
Meta is successfully commercializing its own AI efforts, plus it gets a boost from seasonal advertising. And GOG was around $321. The key is that these are cash flow-rich businesses. They are far less dependent on cheap external debt, which makes them safer havens in this kind of world.
But the narrative goes beyond the public giants. Our sources bring up pre-stocks, these private market behemoths like Anthropic, xAI, and OpenAI. The excitement is huge, but the brief warns about severe liquidity issues. We need to go beyond just the warning and explain the mechanism of that risk.
Yes, this is a critical risk management point for you, the learner. The high imagination around pre-stocks. I mean, you hear rumors about an Anthropic IPO in 2026, and the excitement is immense, but the financial reality is treacherous.
But the problem is twofold, you said.
Exactly. Valuation and liquidity.
Start with valuation.
Their valuations often come from small, recent funding rounds with very well-connected investors, not from the open, regulated public market. This creates huge information asymmetry. You, as an outside investor, you just lacked the real-time data to verify the price you're paying.
And the liquidity constraint.
It's extreme. If you invest, your money is subject to lockup periods, often for years. Unlike public stocks, there's no easy exit button. The secondary markets for these shares are thin, they're volatile, and they're highly susceptible to liquidity squeezes.
So when money gets tight.
When short-term capital is constrained by high rates, the first place money gets locked out of or sold at a steep discount is the illiquid private market.
That is a crucial distinction. High imagination does not equal high liquidity. Now let's pivot to the crypto market. It's been extremely volatile. BTC oscillating between, say, $89K and $91K, and ETH between $3,000 and $3,150 was the biggest driver of this short-term chop.
It comes down almost entirely to institutional money flows, which ties right back to our high-rate divided liquidity paradigm. The key driver, our brief highlights, is that Bitcoin spot ETFs, these massive funds like BlackRock's IBIT, have recently seen sustained net outflows for several weeks.
Sustained outflows. But the structural argument for crypto adoption is still there. Why are institutions pulling the plug so quickly? Is it just high-rate sensitivity, or is it a lack of conviction?
It's high-rate sensitivity paired with tactical positioning. It's not necessarily a lack of long-term belief, but a very high sensitivity to those safe short-term yields.
So they're yield hunting.
Absolutely. An institution that bought the ETF at the peak now sees BTC going sideways, and they realize they can rotate that capital into an ultra-safe RRP or a short-term treasury and capture 3.5% to 4.0% yield with basically zero risk, all while waiting for the Fed to give some clarity. Those sustained outflows just signal institutional tactics, temporarily removing buying pressure and causing that short-term price retraction.
That is a perfect synthesis of the situation. So the market is structurally bullish on AI and core crypto, but it's operationally constrained by high interest rates and super sensitive to fund flows, especially the ETF data in crypto.
Precisely. It's the difference between believing in the story, which is structural, and having the capital to fund the story, which is operational. The high cost of capital just limits how far that valuation can stretch, forcing these tactical retreats.
Okay, let's translate this into actionable strategy for the listener. I want to focus on the application. Given the high rates and the Fed uncertainty, What does the brief recommend for someone leaning toward a more defensive posture right now?
A defensive posture is all about capital preservation and duration control. The strategy favors short duration, high-quality cash equivalents, so utilizing those RRPs or short-term treasuries we've been talking about. The brief also suggests maintaining exposure to traditionally defensive consumer stocks, which tend to be less volatile. The key is just lowering your leverage and waiting for the dust to settle after the Fed speaks.
And what if a listener sees this pre-Fed volatility as a potential entry point for long-term growth? The offensive posture.
The offensive strategy is all about staggering your investment, dollar cost averaging, into the absolute leaders of that structural growth narrative.
They saw the big names.
The big names, staggered investment into the proven AI and semiconductor leaders, NVDA, GOG, and Meta. On the crypto side, even with the ETF outflows, the brief still advises long-term DCA into core assets like BTC and ETH. It recognizes that the fundamental adoption story is still very much intact.
And we have to reiterate just one more time, the severe risk management needed for the private pre-stocks world.
It is vital. If you even consider participating, it must be with capital you are comfortable having locked away for years, potentially facing extreme difficulty finding an exit. Anthropic, XAI, OpenAI, poor liquidity, high information asymmetry, huge lockup risks. This has to be treated as true venture capital, completely separate from your liquid portfolio.
So as we stand on the cusp of this critical communication from the Fed, what does it all mean? The focus is entirely on their policy language, their projections.
The Fed's tone and that quantitative dot plot will decide the near-term fate of these liquidity constraints. If Chairman Powell sounds cautious, or if the median projection stays high, that tight liquidity will remain firm. It'll limit valuation expansion.
But if they signal a more aggressive path to cutting,
if they do that, more aggressive than anticipated, you could see an immediate, sharp relief rally in all these risk assets.
And as we conclude our deep dive, we want to leave you with one final provocative thought drawn directly from our source material about this very Fed meeting.
The policy dilemma the Fed chairman faces is just immense. He has to simultaneously reassure the hawk faction, who are worried about reigniting inflation, and appease the dove faction, who are eager for easing financial conditions. It is an impossible tightrope walk.
So the risk isn't the data.
The most volatile element in the market this week might not be the raw economic data itself. It could be the complex, nuanced, and potentially ambiguous communication that's necessary to keep both of those sides temporarily happy.
Consider exactly how clear or how ambiguous that dot plot will actually be, and what that signals about the Fed's ability to control not just inflation, but the market's expectations for the next 6 months. That's your deep dive into the financial market context for the week ahead. We'll catch you next time.